Good day. I'm Martin Gagel with Market Radius Research. It's Thursday, May the 5th, and we've got CEO Mike Hilmer of Hank Payments joining us. Hank Payments is a SaaS-driven, consumer-based fintech company. I've got Hank on today, and I'm very happy to have Mike join us, as I'm very interested in the fintech space, as it's a huge market with many opportunities to disrupt incumbents with innovative solutions and technologies. It's also one of the fastest evolving and most complex industries out there. And Hank has built a team with significant industry experience and seems to be making some solid inroads. But please remember, this is neither a recommendation nor investment advice. We're here to learn about the company. Mike, thank you very much for joining us. And please tell us about Hank Payments.
Thanks, Martin. Thanks for having us. Yeah, we have a really innovative platform. And just a bit of history, I myself have built SaaS-based companies before. 20 years ago, before they were called SaaS, I built a company. And then I built a lending company, and I didn't really love the lending company. I didn't like the risk associated with balance sheet lending, but I really liked the exposure to the consumer and looking at ways of helping them sort of clean up their own balance sheets. And so, the long and short of it is we created Hank to automate the consumer cash management or household cash flow and take that away from consumers. And so when you think about years ago, budget applications came out and you could download them for $79, but they were passive applications. People would have to go punch in, what they spent money on, what their mortgage payment was, what their car payment was, and it didn't really actively manage their cash. And it certainly didn't do calculations, complex interest calculations, and cash flow calculations to sort of figure out, hey, here's where we can find money to pay off your liabilities quicker. And so we built a platform that does that.
All right.
And so, we think we really matter more than ever. We're all seeing rising rates. Today the market took a pretty big hit based on, the overnight rates going up significantly, probably more hikes coming. That's going to put pressure on consumer cash flow. We see debt levels rising. They're already over 15 trillion in the US. And by the way, Hank is a US centric platform. It's just such a big market. We wanted to be there first, and we're having success there. So we see.
Mike, sorry, when you say US centric, is that exclusively US or just primarily US? Do you do any business in Canada?
No, all of our customers are in the US.
Okay,
and
that's what I thought.
And we've seen it in the past where Canadian companies sort of cross the border and then, kind of fail. We wanted to start there. It's the biggest market in the world for us. California is bigger than Canada in terms of addressable market, and the banking system and the payment environment is highly disjointed there. So we felt that it was set up really well for us.
Yeah, the Canadian and US financial systems are very different. And so state-based and really what works in Canada doesn't really make sense in the US and vice versa. So
yeah, and tens of thousands of lending institutions, which are target customers for us, banks, credit unions, smaller banks.
Yeah,
it's just a massive market and easier to address.
And I think as well, like the US financial system is so much more fragmented than the big five banks we have here in Canada with a few little players. That creates kind of an opportunity for you as well, where it's so disjointed, right?
Yeah, definitely. And the way money moves in the US is very different. As an example, a big percentage of the auto market is what I call push payments for simplicity, where even on a car lease, oftentimes if you buy a car or you finance a car, you don't have to leave a void check in the store. And so you're sort of leaving, then in 2 weeks, you get a notification package from the lender, and then you have to set the lender up on your banking platform, and then you have to push the payment to them every month. And that's in many cases. And a big percentage of the market is still checks. So when you think about that, all the burden is on the consumer just to make sure those payments all get out the door within the grace period. But a lot of the financial institutions don't talk using the same payment protocols. So sometimes customers are moving money from bank to bank to pay the bank or pay the lender. So it's completely different and often hard for Canadian consumers or investors to understand.
All right.
Yeah, so burgeoning debt in the U.S. I mean, we're trying to get people out of debt by not loaning them money, and we think that's pretty attractive, just as an offering. And there's a lot of fintechs out there that lend money. There's a lot of sort of instant credit opportunities. I mean, I could buy hockey tickets in 4 easy payments today if I wanted to. Debt is so accessible. And those lending companies are getting phenomenal valuations, but the exposure, I think, is to that household is just deepening. And by and large, a consumer will take money when it's offered to them, and they won't think really about the consequences on their cash flow. And then 4 easy payments later, they're going to miss that last payment and hurt their credit. So we tried to deliver a solution to customers where we manage the payments so that every couple of weeks, we take money from their bank account. But generally, it lines up with their payroll. So our system runs an algorithm. It looks at their cash in and it looks at the payments that have to go out, looking primarily at the debt payments. So credit cards, mortgage, insurance, whatever, and auto, student loans. We actually are starting to see many more student loans, which is a whole different ball game in the U.S., as we all know. And we create a payment schedule whereby we tell the customer, hey, we're going to take $1,000 on every other Friday, and we're going to move it over to a bank balance sheet in your name. And then our system is going to tell that bank to make these payments for you in these amounts. And we do that religiously. So it's the platform runs sort of every day, 7/24. We're processing over 21 million a month in payments and growing. And we're cleaning up the consumer's cash flow, but also increasing the payment propensity. So when you take smaller, more frequent payments or make smaller, more frequent payments for the consumer, it can improve their credit depending on what you're paying. Our platform also looks at interest rates. What's your highest yield or highest cost of money? So a lot of people typically are conditioned to pay their mortgage off quicker, but mortgages historically have been 2.5% to 3%. Credit cards are much higher. So they're carrying a credit card balance that might be costing them $200-300 in interest every month, but they're paying their mortgage quicker. So some of these things don't make any sense. So our system allows them to say, hey, pay my highest cost debt first. And if there's extra money, apply it to the highest cost debt. Or they can say, pay off my lowest balance. So if they have $1,500 left on a line of credit, pay that off first and reduce the total debt load. So it gives them some of that flexibility. So our power users are, consumers that are paying, I think our biggest power user is 32 different payments, including 3 different payments to 3 different student loan providers. And the ironic thing is when we built the platform, we thought, hey, this is going to be great for subprime customers. They're sort of in trouble, not really great at managing cash, and a whole bunch of other characteristics. But as it turns out, 52% of our customers are prime credit. And back to the US fragmentation in the payment market, it's just easier to manage their household payments on our platform.
And I guess going where you initially talked about that there's push payments going on, in a sense, some of the lenders don't necessarily want to make it that easy to pay it, because if you're late, then they get to charge late fees. And it's not even just the nominal interest rate, it's all those other fees that they get to collect if things don't work out quite as well, right?
You're probably the first guy that's actually figured that out in 10 seconds, but yes. And we see that in subprime lending.
Yeah.
And when we look, so we pay over 400 lenders today. Most of them are through automatic payment protocols, whether it's MasterCard's RPPS, Wells Fargo eBucks. We have multiple protocols we're integrated with, and we pay electronically with a ledger as to how to apply those payments. So for example, TD Auto Finance, we pay 3,500 customers loans for using those customers' cash. So we'll send one payment to them and it'll say, it's covering these accounts. Now in the subprime space, they're more resistant to letting us pay them electronically. COVID, believe it or not, because they want that check to be late. And I'm not saying they want it to be late, but it benefits them if it's late, right? Yeah. But COVID actually turned out to be a very interesting cycle, and there were some interesting things that fell out of that. And one of them is the mail stopped moving for a little while. So everybody who was mailing checks was late. And it was seen to be sort of unfair and inappropriate for lenders to really kind of harm them, let's say, or beat up their credit when they couldn't even receive those checks. So we saw through COVID, many more of those lenders coming onto our digital platform as electronic payees. But it's a very good catch because the late payment fees can be quite extreme.
And I'm curious, whenever I set up a new payment in Canada, it's relatively easy online and stuff, but still it's always a pain. You got to figure out this. Do you actually make it easier if one of the lenders is already on your system for the user, let's say me, to like add TD Auto Finance or whatever onto it? Since you already have those connections, and does the consumer just make one connection to you, and then all of your network is made available to them?
That's right. Look at it from that perspective. We're sort of aggregating it. So you only have to give me your account numbers and routing numbers. So let's say your loan ID and your loan number, and we know where to send that payment.
Okay.
So one of the before Hank, you get paid every other week, and this is an example of a month, which is typically this happens 4 times a year, typically, where there are 3 Fridays, let's say, or 3 payrolls in a month. So you got bills coming out all over the place, and you're cutting checks and doing all these things, and you've got to keep enough money back to get to your next payday to cover the following bills. So when you add us, we sort of reimagine how that all happens. We still take the money so you get paid, but we do a debit on that date. And we do this weekly for some customers. It just depends how they want to manage their cash flow. If they're not really great at managing cash, they might say, okay, take it every week, take a little bit every week, keep it away from me, so to speak. And then we will remit those bill payments. But this is a real simple example of how we pay people's loans quicker. So if I'm collecting 4 times a year when there are 5 Fridays in a month, an extra payment every month or an extra bit of cash from you, because you're now conditioned to give me that cash every 2 weeks, I have cash building up that can be applied to multiple things. Some customers say, I'm going to take a payment holiday at Christmas for my car loan because I've got other expenses and I know I've got a balance sitting there that allows me to do that. Other customers say, no, pay my highest interest loan off with the balance that's building up. In addition, they can say, okay, take an extra $25 every week or $50 every 2 weeks, set it aside, and I'll decide later what I want to apply that to, right? So it adds the discipline that is sort of severely lacking in a lot of households.
Okay, so you will actually withdraw, like I see there on Friday the 2nd, you're actually going to withdraw the money then, but then hold it and only pay it to on the Wednesday the 7th bill. You'll hold it for those 5 days until you pay those guys.
Right.
So it's out of their bank account, so they can't be tempted to spend it.
Right.
Okay.
Exactly. And so I might take $1,000 on the 2nd, but this bill on the 7th might be half of your car loan, $250. So I've still got $750 sitting there. Our calculators are really complicated that sort of figure this out, because I've kept back $750, and that's going to deal with the next 2 bills that are coming up as well. So I'm not coming back to you. But I want to make a distinction here. This is something that we think is really innovative. We actually never touch the customer's cash. This is why we're a SaaS platform, right? So we partner with banks, and banks can move money sort of across all state lines. So we wanted to be the traffic cop in the entire equation, right? So our platform tells our bank partner, okay, debit Mike Hilmer $1,000, wait for further instructions. So our bank partner puts that in an account and waits for further instruction. And then the bank remits the payments using our protocols that we've integrated with the bank. So we control the payment protocols that we sort of license into the banking relationship. And then we say, okay, now remit this cash. So I think the really interesting thing about that from an investment standpoint is we have to go through an FDIC audit every year. Even though we're not touching cash, we're managing the ledger. So our ledger reports to the bank, you should have $1,000 in this account, $600 in this account, 10 cents in this account. And you have to reconcile that daily to the penny. And our system does that automatically. to support the bank's audit process, and then that is audited by the Fed every year. So and those deposits that we're collecting from the consumer are FDIC insured because they're sitting on a bank balance sheet.
And I just wanted to clarify that. So when you take it out, it's not going to your balance sheet. You're not a financial institution, although it looks like you've got some FDIC regulatory stuff you have to comply with, but you're not taking that cash. The bank just puts it in a trust account or something like that, and then allocates it out after when you tell them to.
You got it. That's exactly right.
All right.
Yeah. And we think, I've been doing this kind of stuff for 20, 25 years, and I think compliance and risk mitigation is really important. And we've seen guys trying to build platforms that are similar like this, that commingle those customer funds with their own working capital, and they actually book it as an asset on their balance sheet. That's not their money, right? So
yeah, well, and like a bank, when someone gives you money, you take the asset, but then you've got a liability at the same time as well.
Right. So that's sitting at any given time. I think we have 8-9 million US sitting there as an average daily deposit. And as we grow, that number we expect will explode. And so we pay the bank to process these payments for us, right? And we're happy to do that. And it's relatively nominal for the great service they provide for us. And they make a little bit of extra overnight interest on those deposits, and it provides some leverage for them.
Right.
So it's a bit of a win-win. I mean, we think banks in the fintech landscape play a huge role, and this is just a great example of how to partner with banks, where a software company comes in with a better mousetrap for helping the consumer, but the banks are always really important pieces of the fabric or the ecosystem.
I guess on a technical note, not that bank account interest rates are really worth a whole lot, but on the Friday when the money gets taken out, the consumer stops collecting that little bit of interest until the payment goes out, I would guess.
Yeah. Okay. Yeah, we don't offer interest on that, and we don't get paid interest on that. Okay. We know if the deposits get to a certain threshold that there's income for us there, but it's not really a big driver for our business.
Yeah. Okay.
And I think the consumer is more concerned about just benefiting from the convenience of the platform and paying the bills.
Yeah, those fractional cents aren't really worth a whole lot.
No. And so, how do we get customers? And we see a lot of fintechs that go direct to consumer. Digital marketing, lots of interesting ways of getting consumers. Depending on your margin, that payback can be 6 months. It can be 3 years, depending on the breakage of those consumers coming on and then dropping off. We took a different approach. We wanted to deliver this to, customers being businesses that are already talking to the consumers. Whether it's, auto dealers, if I'm about to close a deal with you and I'm going to finance your new car at TD Auto Finance, the finance manager and the auto dealer offers this to the consumer and says, look, you want to stay on track with your payments, maybe build equity in your vehicle quicker, sign up for Hank, right? And so they sell the program for us. Historically, that's our bread and butter. And that's a really good channel. And all the growth has come from auto dealers, mortgage brokers, and sort of white label partners that are already talking to the consumer. And it's one of the reasons our margins are so high, because we have a very low customer acquisition cost you sign up an auto dealer and then every month you get business, right? Now that we've collected so much data on how those customers perform and how those loans actually perform on our portfolio, and delinquencies typically drop about 50% relative to market for customers on our platform, we started approaching much larger channels, channels that have 1 million customers, right? And there might be a lender or a bank or a credit union. We're finding a lot of interest in credit repair companies, debt settlement companies, because they're trying to help the consumer, but they're literally calling the consumer every month and walking through their budget and trying to keep them on track. And they see a lot of value in bringing our product to them as a way to automate that. So we have a number of opportunities we're pursuing there. And the nice thing about these is they're quite big and they're quite profitable. And so, in terms of things to watch for, we think the next 12 months we'll see a lot of successive wins in the enterprise channel space. And the licensing, revenue is pretty phenomenal. And again, all we have to do is go close that deal, and they go offer it to their consumers.
So could you, and I'm not trying to who you're pitching, but who would be an example of a company? Would it be a big name brand bank or TD Auto Finance, someone like that? And I'm just saying hypotheticals. I'm not trying to pin anything down.
Yeah, these are name brand accounts.
Okay. And then they would say, hey, this is great. We're going to encourage our users to take this on so we get regular payments and sort of part of our value added service.
Exactly. And the funny thing is so a couple of years ago, I went traveling around talking to underwriters for auto loans, and I wanted to, either get thrown out of the boardroom or, get nods in terms of our thesis for the business. And we hadn't at that time collected enough data on loan performance, but it looked like we were improving the loan performance. So I went down to see a major one that underwrites 1 million loans a year, and coming from lending, so I did a sort of a lending pitch. Hey, you can increase your net interest margin because your delinquency should fall, and then you can refinance some of this lower end credit at a lower rate, but extending the term once they improve their credit, assuming that they stay on track with our program. And the response I got was, hey, this is awesome. We can actually buy down to 500 FICO scores instead of 600 FICO scores, and it won't affect my delinquency rate, right? So they looked at it as a way of originating more loans.
Yeah.
But that was great feedback, and sort of we sort of merged those thoughts and data points into our thinking, and we started earlier this year going out to market with that. So there's a lot of value to banks and lenders. This is also an additional income stream for them. Think about like insurance on your credit card, right? $9.99 a month. People don't think about it, but it's there if you need it. Banks and lenders and some of the other partners we're talking to are thinking about it as another income stream where they're actually helping the consumer. They're helping the consumer build equity, which means they can be refinanced as a new origination, let's say, or put more capital into that household at a lower rate at the future. So they keep the customer in the ecosystem. They know everything about the customer because all those payments on our platform, which that bank would get access to. So they know, hey, that mortgage is coming up in 6 months. I don't have his mortgage. I can market to him for his mortgage. So there's a whole bunch of things that they benefit from. We see other channels or customers here in the enterprise space that are going to give it to the customer for free. For their own reasons. And if I tell you the reasons, it'll be obvious who the brands are, and I don't want to sort of disclose anything here. So they're looking at it as a value add to retain their customers. So there are lots of different use cases that we're starting to see come out. The more we talk to these people, the better. And so our focus really, when it comes to enterprise channels, is we're not worried about, are we going to win really nice material deals with really high cash flow? I mean, a 20,000 accounts to us is worth about $1 million a year, and about 80% of that is margin, right? So those are kind of the rough metrics. Now, for volume, we'll give discounts, obviously, but those are the rough metrics. So we're not worried as to whether we are going to win business because we have some fast-moving things on the table now. I think as leadership, what we do is think about, well, how many can we launch, and really looking at our factory, meaning our implementation team and our implementation capability, and making sure that we're continuously improving and resourcing properly. So we're not sort of too top heavy too soon, but we're able to resource up those teams to activate these deals, and try and get some momentum on successive launches. Our ideal scenario is launching a material deal every month, right? That's where we want to be.
And are currently your financial institutions are they using this to augment their client information, to kind of augment their FICO scores or their credit rating scores? So it's like, hey, like you said, we normally go to 600. Now we can go to 500 and cherry pick the 500 FICO score guys who we think will repay their bills earlier.
So we don't sell it as a credit builder.
Okay.
I mean, we sell it as a platform. Now, one of the add-ons that a financial or any of our customers can pay for is credit. We're integrated with a bureau, so we can pull credit scores and show them every month what that credit score is, and marry that up with the payment history and give them that data. Today, I'm not necessarily positioning it with as a decisioning tool, but we do think what's missing in bureau reporting is the propensity and willingness to pay. You get no sentiment data, and I was a credit guy, so I had to build my own algorithms as to how I would underwrite deals. There's really no sentiment information that you get, and you're starting to see a lot of these new credit algorithms companies sort of socially re-engineering you, looking at behaviors and all those kinds of things. Well, we think there's behavioral data in our data sets that will help them make decisions, but we think those are additional license opportunities within those channels if they want to rely on that data. Because I can anonymize all of our data sets going back with years of data, and the more aggregate customers I get from all these channels, the more aggregate data I have. And I'm hopeful that I can show, hey, everybody that came on as a 620 FICO score 2 years ago is now a 720 FICO score or better, right? And the more that data builds, and the more valuable we think our platform becomes, and indispensable then to underwriters. So long way of answering your question, Martin. So today we don't position it that way, but the aggregate value of the data, we see many use cases in underwriting for that down the road.
All right.
So our revenue model is pretty straightforward. On the SMB side, so we sort of set the retail price in the market for what our partners can sell the product for, right? Because we want to make sure it's still fair for the consumer, and that partner is competitive. So in the auto sector, as an example, we allow the channel to charge as much as $399 for a customer to enroll onto our program. Now, our platform looks at that $399 in the context of the ongoing cash flow, and it's collected fractionally over those payment cycles. So the customer's not getting a $399 hit up front. It generally comes in over the first 12 months in fractional payments, and a percentage of that comes to us. And so the idea being that if the channel had to, incur customer acquisition costs, they would recover that with profit through the enrollment fee. And then there are ongoing processing fees or per debit fees. So simple, and I sanitized some of the numbers in this deck because we don't want to get too much information into the market. But say an auto customer is about $5 a month, but a heavy user could be $20 to $30 a month, right? In terms of processing fees. And generally on that side, we keep all of the processing fees, which continue for the life of the customer on our platform, which today has been about 3 years.
So if I get if I go buy a car and they offer me a loan and they say, hey, we can add this Hank payment system, or do they call it Hank, or do they white label it and it's just some whatever Bob's Loans?
Yeah, they white label it, powered by us. Yeah.
Okay. We can offer that to for $399 or whatever, $5 a month, or however they position that. And then if they get a mortgage somewhere and those guys offer it, like you're paying for each lender that is on the system, or like sort of once you're on it, then you can throw as many sort of payment options.
We cap the total fee in terms of enrollment that a customer could be charged.
Okay.
So if they came in, let's say they came in through an auto channel and then their mortgage broker, which hasn't happened yet, says, hey, I'm going to add a mortgage, and here's the enrollment fee on mortgage. There's a cap so they can only charge the delta, let's say, to the consumer, because we want a fair market for the consumer. And then the aggregate processing fees all come to us.
And if I want to add my cell phone bill onto your platform, I'm the consumer, does that then cost me extra, or is that covered by the overall platform cost?
Generally, we charge $1 per payment out.
Okay. So you can add additional ones, but then you have a transaction fee associated with it.
Yeah.
Okay.
Yeah. Now we are working on subscription plans that are bundles. So super simple things, $9.99 to $19.99 a month, and here's how many payments you can make. Just to keep it simple, because we want to encourage usage. The more loans or the more payments people have on the platform, obviously the higher the customer lifetime value, but the longer they're going to stay on the platform because they become dependent, right?
Yeah. And like right now, can I buy this off of the App Store and just say, okay?
No, it's a SaaS platform. I mean, there's a whole bunch of back-end plumbing that, that manages all of this.
Yeah.
So no, we don't sell it as an app per se. What we do is integrate it with existing, let's say, portals. And if there is no existing portal, then we can deliver a Hank branded portal to the consumer so they can monitor everything and change things, or a white label portal. We're working on white label portal capability later this year. Yeah.
Oh, so if I'm working with whatever auto loan company, I'll go onto their website. There'll be the payment management system, and then that's powered by Hank. And then I coordinate it through there. There's not sort of my app that I've downloaded that it runs through.
Yeah. I mean, if you look at a lot of the small credit union websites and small bank websites in the US, you'll see, how to make a payment. And they give like, 10 different payment options. So our goal in those channels is to be one of those payment options.
Okay.
For how to make those payments. And then it's really up to the channel. Do they want to have their brand on it or us?
Okay.
The enterprise space is even more simple in terms of the way we price. It's basically per customer per month. So let's call it per user per month from a SaaS perspective, with volume discounts. And it's packaged as like, what features do you want? So if it's just, call it 3 payments for $9.99 a month, 15 for $19.99 a month. If you want credit reports for your consumers to show up in the portal, that's an extra fee. So we have various bundle options for the channel. And again, we recommend the MSRP for the usage of that. And in this case, it's a little bit more interesting. We're doing some customization now on the platform that allows, so a bank that has 1 million customers would probably rather do the processing in behind that versus my bank partners doing the processing. So we're working on some features that allow the bank, let's say my integrated bank, to be detached and replaced with the bank channel as the processor, right? And because that benefits that bank as well, and it actually drives revenue for the bank as a channel. So same sort of model. It's a MSRP, and volume discounts. Same sort of duration on customers. Very long life of these customers, and CLTV 300 to 600 plus.
Right. And just to clarify, CLTV is cumulative lifetime value?
Customer lifetime value.
Customer lifetime value. All right.
Yeah.
Gotcha.
In each case, we take a small piece of the enrollment fee, which is an activation fee for us. And it sounds like just a piece of software, but because it's integrated with the banking systems, we do OFAC checks. We actually do all the AML. We do a whole bunch of know your customer work on the back end. There's automation and costs associated with that, and that's part of surviving an FDIC audit. Like, we want to know who's coming on our platform, obviously, and we want to demonstrate that we know who's on our platform and where those funds are coming from as they move in and out of the bank balance sheet. So there's a bunch of things that we've automated in terms of ingesting customers that that we incur a small cost for, and we take a piece of that upfront fee to cover that.
Gotcha. Do you have any risks of, like, you talk about know your customer and anti-money laundering stuff, which is standard in the financial services for anyone? If you take on a bad client who's laundering money, or you don't know your client and they're doing something funky, could that have could that have blowback upon you guys?
Well, I think optically there's always risk. And so that's why we do those checks. If we can't source who that customer is and match up various pieces of identification, we simply won't take them. But we also won't take certain kinds of certain sizes of loans onto the platform. So, I remember last year we had somebody with a $5 million mortgage that wanted to come on the platform. And we thought, well, that's kind of strange. And so we set a threshold in terms of the total liabilities under management that could come on the platform. Yeah. And it doesn't mean that, people with $5 million mortgages are bad people. We just thought that was such an outlier. It wasn't really worth the extra due diligence work to ingest that customer automatically. Yeah. So, I think in time we can change those thresholds, but we'd rather be safe than sorry.
Makes sense. All right.
We just announced last quarter, I think week before last, and this doesn't include any of the enterprise business. I think, what the market will find out, I think soon enough, is that, the bread and butter, the proof of concept and all the thesis is what's driving these numbers. The enterprise accounts create the real inflection for this business. In terms of backlog revenue, which is revenue earned over time, number of accounts added. I mean, that's the big chunky stuff. And we're seeing a ton of traction there. But even in the bread and butter channels, which are great channels for us, and our team does a terrific job managing them, we're growing. And it grows sort of automatically. And if you look at the auto, and we expect growth to continue in those channels, because as auto inventory comes back, more car sales will happen, more truck sales will happen, and that will just continue to grow. And with higher rates, our platform actually becomes more attractive, because if they stay on the platform and they use it to make more frequent payments and maybe a little bit larger payments, they can save interest and build equity. So, this does not include really any of the material business we're working on. And so we're pretty excited about, what's coming up. But, it's such a predictable business. And that's why I think SaaS businesses are really attractive, and why I built one before. They just become very predictable. Two decent sized deals, could have us generating positive cash flow very quickly, right? And then everything from that point forward is accretive to cash. So we're really focused on, we think, long-term strategic, and quarterly tactical, and weekly transactional, if you will, because there's very specific things we're trying to get done. The only thing we don't really control is time. So we try and influence time and decisions as fast as we can without negatively impacting deals we're working on. But I'm pretty optimistic as to what's coming down the pipeline and its effect on the statements, but also the value of the business and the revenue.
Your gross profits are approaching 90% here, and what kind of and your last quarterly revenue is 1.38. What kind of revenue size do you need to get to sort of hit that break-even threshold?
If I added $2 million a year in revenue and kept my operating costs, which includes our internal R&D, marketing, and all of that. Yeah. If I added, and this is again why people love SaaS companies, and I do too, is every $200,000 a month in revenue that we add on enterprise accounts, let's say, puts about $150,000 to the bottom line, and then we're break even. So we don't have to. And actually, if you look at 2 quarters ago, I think the amount of cash we collect in fees So if you look at a traditional business, say you have $100 in revenue, have 15% EBITDA for simple numbers, $15 to the bottom line. You would have to go, geez, I've got to multiply my revenue by 15 times to get, or 10 times to get to 150,000 EBITDA or cash in most businesses. Of course, IFRS kind of makes it a little complicated to dissect cash flow, but we actually collect more cash than revenue recognized each month. And I think it's in the order of 1.38, we probably would have collected about 1.45 in cash.
Okay.
And that's all fees.
Yeah.
So our job is really build up that fee backlog. And if you think back 20 years, I think you've probably been around, Martin, as an analyst back in the day when Salesforce was kicking around and getting going. Sometimes the income statements don't tell the story.
Yeah.
And Salesforce was a great example. The income statement didn't tell the story. So they talked about bookings and backlog, because that was a signal of cash that's coming in over a committed contract term. And it didn't necessarily, connect well with the income statement presentment. And so we spend time, with our prospective investors and existing investors saying, listen, I only need to bring in about 450. I need to increase my cash flow by about 30% a quarter, which is not that much, because when you have margins at 90% to be break even. And I think that's really attractive for these kinds of businesses.
And you're able to grow that without growing your SG&A and R&D and so forth. You should be able to keep your sort of fixed expenses relatively fixed throughout the growth.
Well, I don't think that's, and a lot of guys ask that. For a software company, you're always investing, right? You're always advancing software. For example, we're doing a multi-tenant sort of build out of the platform to accommodate all of the enterprise deals coming in. And so those are sort of one-time investments, and then there's sort of the maintenance costs, let's say.
Yeah.
So, the way I built software is the big chunky spends will outsource that. And that's typically capitalized, because you don't need to add 20 developers, because you wind up finding work for them to do that maybe you don't need them to do. Yeah. So we'd rather keep the product people and sort of the brains and the engineers and the design side, the architects in-house, and then the actual work gets done by third parties. And that way you scale it up and scale it down as you need it to be, as you need it. So, but you're always growing your overhead associated, because the more success we have in the enterprise channels, the more salespeople I want talking to enterprise channels, right? Yeah. But it's a predictable payback. I think if you're throwing money at channels that aren't yielding, then you've got a problem, right? So as we start, and I'm on sales calls, like, CEO has to be a sales guy too, right? So, myself, my head of, banking strategy and sales, we do these calls. And so we work these deals, we're bringing them back to our organization. Our team knows what the deal is, and we kind of get together in the room and we develop the launch strategy and we launch. So the more of those we do, the more we'll be able to support a larger team of salespeople. So you have a funnel of 50 or 100 of these ready to go at any given time. And then you have a launch team that ingests these deals. So, that's not to say I plan to burn cash. I think we're going to generate really nice cash in the not too distant future. But I think you have to really unlock all the value and capitalize on all the opportunity. You have to be judicious in investing.
And you don't actually target Joe consumer as your customer acquisition cost. You're targeting Joe lender, who then targets the individual person. So you're never targeting the end user per se. You're charging the lender or the financial institution that's going to be gathering it. And that's your customer acquisition cost. Is that right?
Yeah, that's right. I mean, and we looked at that. We were doing digital through COVID, like a lot of guys kind of pivoted into digital. We were doing a fair bit of digital. We found our CAC was around, which our customer acquisition cost was about $200, sometimes much less, but call it $200. And we were taking more of the enrollment fee and some of the other fees in, because that was a direct originated piece of business. And, we sort of looked at that and thought, well, if I want to scale to 1 million customers, theoretically, I have to spend $200 million, right? Now I'm going to build a huge tail on cash flow that's going to dwarf that number by a real order of magnitude. But you're not going to close 1 million customers overnight, right? That's going to take years to develop that. And then so we started modeling out the enterprise space a little bit more and starting to talk to these accounts and going, okay, let's license the platform to them. They already have 1 million customers. And what our cost is my time, my leadership team's time, and my project team's time to go close that deal, right? And so all of a sudden the economics look phenomenal. So it was pretty clear to us that that is the most economical way to aggregate customers, income, long-term cash flow, and data, massive amounts of data.
All right. Okay.
Canadian investors don't, and I'm a Canadian guy, but Canadian investors don't always understand, why can't people do this themselves? Well, I think we covered off at the beginning of the call why it's kind of complicated, and obviously you have a bit more of a purview into the disjointedness of various markets. But we've got over 42,000 people paying. We don't do any premium programs. We believe if you're providing value, you should get paid for it. And I've seen too many times guys racing to the bottom on pricing, and then nobody's making any money down there, and their business models break. So we think what we have is good enough to be paid for, and it's proving itself out. We've made now well over 3 million payments for people over the last 3 years or so, paid off close to $1 billion in loan balances, while adding more loan balances through new customer acquisitions. And we have no balance sheet exposure. So if when we go to debit a customer's account, if the money's not there, we're not bridging them $50 or $100. Now, we have partners that would like to do that, and we may allow them into our ecosystem because since we control some of the cash flow of the consumer, it's a pretty decent credit risk, and we'd hate to NSF somebody for the sake of $50 shortfall, right? That's not really our business model. Our business model is to help get them well. And so if there are partnership opportunities with banks and so forth that would like to put a little borrow into that consumer on their balance sheet, we're happy to make that introduction, do the integration to bridge them to $50 or $75 at the time of need. And I think that's really important. When I think about lending, too much lending is for wants, and not enough lending is just at the time of need. And we're seeing now with some of the biggest companies in the world, payday lending style companies are integrated with their payroll systems. So if you want a cash advance off your paycheck because you can't wait another week, you can actually get a cash advance off your paycheck. We don't think that really helps anybody. It actually conditions them to not think about their cash flow and manage their budget properly. So
the fees on those are ridiculous. So
absolutely. Now, I would say that, I don't think those fees are like payday lending because payday lenders don't really have that recourse or the assignability of that paycheck as readily as getting the company to sign and the employee of the company to give an assignment of that first $200, right? So I think the risk is much lower, so the rates are a lot better, but it still doesn't teach anybody anything about managing cash flow. So So giving them that money that early in that cycle, we think is risky. But if somebody wants to, is really in a jam and they need $50 or $100, we're happy to make an introduction. And we think that'll be a big part of our equation next year, and I'm not saying that's a big revenue opportunity for us. There will be fees, but I think it'll help consumers not sort of damage their credit because they were short $50, right? And then they had to pay $25 NSF on top of that. Like, who does that help, right? So, so we think there are opportunities there, and our income and our revenue stream is 100% income. It's all, fees. I mean, it's one of the most attractive recurring revenue streams that I've seen.
Yeah, and just to clarify on that, you're clearly a SaaS business, but you're also transaction. Because every time you pay a bill, it's not just X amount per month. You pay a bunch of bills this month, $1, $1, $1. That adds to the pot as well. It's a bit of a hybrid model.
Yeah. Yeah, it is actually.
And it's highly recurring transactional, but it's SaaS and transactional recurring.
Right, exactly. And the way we've been sort of structuring our new agreements is with that in mind, because there is a licensing piece, right? There's an accessibility piece, get access to the platform, but we do this, when we bolt in the bank and we do the processing, that's another piece, right? Together, they form one transaction fee as far as the consumer sees it, but it's really two distinct fees, right? And so we're doing it that way so that if another bank partner wants to say, hey, I'll do the processing side over here, we can just bolt them on instead, and they're going to get a piece of that, right? So yeah, it's really a hybrid. It's very interesting, I think, and it's different because we do see a lot of fintechs that are sort of free to the consumer, but they're making money on the interchange, 2.5% and so forth, and they're getting, they're achieving massive scale, but they have to achieve massive scale. Some of these companies have to do 400 or 500 million, $1 billion in revenue to break even. And, we sort of like making money at about 7 million in sales, right? Or less, it feels better, right? So, especially when you see a Dow drop $1,200 and you're, when you have that kind of a burnout there in some of these big organizations, you're dependent on the capital markets for growth. And if the capital's not there, you kind of have a problem. So, we'd rather go a little slower, make a little bit more money than most of the other fintechs out there. I think we make more than just about any other fintech I've seen, or because it is a SaaS platform. But we think that's a safe way to go here. And in the long run, I think we'll be proven right that it was the right way to build the business.
And you don't have any direct interest rate risk, whether the rates are going up or down, you're charging yourself. It may change consumer behavior where they pay off their loans sooner and it hits you, but it's not like if it goes inverted yield curve, it screws up your financials or does anything weird to you guys. Not
at all. No, there's no sort of derivative risk anywhere in the equation.
Yeah. Okay. Interesting. All right.
We're everywhere, across the US, where we have customers in every single state already. So we're
every state, your states have different colors. Does that mean anything, or are you just saying that you're in all the states?
It's just to make it more distinct.
Okay, but so you're operating in license. Do you have to get licensed per state?
No, because we don't touch the cash.
Yes. Okay.
Right? So huge advantage. So we have an office in New York here. We have an office here in Toronto, obviously. We have an office in New York. That's our sort of our back office treasury function that is, monitoring all the events going back and forth between the bank and us and making sure all the ledgers line up. And they run all of our cash management tools as well. And then we run all our customer service out of Florida.
Okay.
Just back up to this slide, emerging data points, kind of interesting. Here's who's on the platform. We didn't really know. I mean, other than thinking it would be a platform Prime customers would use. We didn't really know about age groups, to be honest with you. We weren't thinking about that years ago. We were just happy to get people using it. But this distribution is fairly interesting. And in fact, when I overlay the digital ad work that we did and the clicks from Facebook and so forth, we found the most interested parties in the platform were men 29 to 49. And this turns out to be the demographic of people using the platform today. And we have people in their 60s, it's a small percentage that are using the platform to manage bills. So, I put this up because, when you think about addressable market, we're not going after 1/10 of, 1/100th of a very specific market segment. This fits for everybody. It's 330 some odd million Americans out there that, theoretically could be customers. I'm not suggesting we're going to even get a penetration rate there, but I think with our wholesale and enterprise channel relationships, getting to 1 million customers is very doable. I can't say when that's going to happen. I have some opportunities we're talking to that, will take some time to close, but they could theoretically put us there fairly quickly, depending on the adoption rate on their side. But I think when we think about our stepping stones, it's 100,000 customers, 250,000 customers, 500,000, and $1 million. If you just use $5 a month as an average fee that you get from any one of those customers at 80% margin, you can and assume, based on, even if the overhead grows at the same rate as the revenue grows, your margin contribution, your net income contribution is going to be phenomenal. So, we're happy that everybody is using the platform. This helps us with our banks, lenders, and strategic partners we're trying to close in the near term here, because it makes it easier for them to target their customers and who would be good users.
Yep.
And we're adding more interesting things, right? We have credit health reporting. That's an add-on for people that want it. One of the things that comes out of the platform is, we can see who's sort of faster paying a loan relative to the term they signed up for and when they are likely to pay that loan off, which is usually, if they stay on the platform, much earlier than the committed term, right? And so that is useful to a bank or a lender who might want to target that customer to loan them more money, or halfway through their auto loan, maybe refinance them at a lower rate. So one of the things we're working on is sort of the ability to surface that data for these banks and lenders so they know when to approach that consumer and make them an offer, let's say, whether it's a credit card or whatever they want to do. Now, we think this is another fee category for us that's over and above the licensing, and this can be transactional. So as an example, if I found, Wells Fargo a customer and they financed them $30,000 for a car, then we would take an origination fee for that, somewhere between 1% and 2% of the capital advanced. So, we have talked to parties about that. I've been called by banks asking to be bolted into our ecosystem to see if they could bid on customers. We've refrained from doing that in part because we didn't want to cannibalize the channels that we're trying to insert this platform into. So let's say Wells Fargo signed up for the platform and they started using it. I would be thrown out of Wells Fargo in about 2 seconds if I show TD Auto Finance a Wells Fargo customer to refinance it, right? So what we want to do is sort of try and help those institutions keep the customer within that ecosystem, but find more opportunities to provide capital to good customers.
Oh, okay.
And similarly,
and the middle guy in there, I guess you really do have to, you can't be too cute about it. You got to respect your existing clients' relationships, but then also add value where it kind of makes sense and the opportunity arises to the consumer. So you have to think before you walk, I guess.
Yeah, I mean, absolutely. I think, and I ran into this before when I had another SaaS platform. And it was really important: data segmentation, complete separation. Generally, these agreements require us to respect that customer is the customer of that bank, and we're okay because we're basically a software company with all these value add services that sit on top of it. So that's okay with us. We don't have a problem with that. And another piece that we're working on is, because we control the waterfall of cash flow. A customer could say, hey, look, I want to save $100 a month as well. Can you do that for me? And so we're building out that capability which is basically a deposit builder for banks and for consumers. So we're building out some of those capabilities to attract more of that household income to that bank. So, a whole bunch of interesting things will be coming out. And back to my R&D comment and the growth in overhead, we will invest in things that we think generate more reoccurring revenue and increase the value of any enterprise account or any consumer on the platform, right? There has to be a payback. And these are the things that we think offer a payback. There's all kinds of other things that we've thought about that we've shelved because we really weren't sure what that payback was going to be. But these, we know there's a definitive payback.
Okay.
This is just a snapshot of some of the dashboards that are for the consumer that are being put in place. Now we call this Hank 2.0. So, credit reporting, we're actually going a little bit further with what we're doing and designing an income statement and balance sheet presentment for the consumer so they can really start to understand their own equity, if you will, because nobody thinks about equity, right? And so where they're spending money. And this is interesting because open bank APIs are very interesting to us. And we have an integration already with one of the platforms out there. We haven't turned it on or exposed it to the consumer yet, but it allows us to see what all their spending looks like out of their primary bank account. And I think this is really important. So when I think about what is Hank doing in 2 or 3 years, right? I want to use that financial data to create alerts that will send you, Martin, a notification. If I think you spent more money last night than you should have out with your buddies, I'm going to send you a notification to remind you that you got a $300 payment coming out on Tuesday. I know you have the money now, but it's Friday and you might spend it. Can I take the money now and move it away from you before you do something silly with it? And so we want to start ingesting more and more of these data points and try and influence the consumer behavior. This is not this year. I'm not saying this is happening this year, but this is roadmap stuff. And back to the R&D, this is really important because when you can, first of all, consumer financial data next to health data is the most valuable data in the world. And if we can influence a consumer's path one way or the other, whether it's borrow from this institution at this rate or don't spend that money or let us take this money before you do something silly with it, then you're showing that your customers are engaged. And when you can influence your customers, somebody shows up and says, we're going to buy you, right? That's kind of the logical path. So the more data points we can ingest and make sense of, like it's pretty easy to pull in data, but making sense of data is really the hard part. And the more patterns we can recognize over time from these consumers, the better decisions we can help them make.
Right.
And I'll spare everybody the details here, but back to the data. We're ingesting a lot of data. We're going to leverage this data to monetize it into other fee streams. I think I've kind of hit on this, quite extensively. So I'll save you the diatribe, so to speak. So things we're working on is advancing the foundation of our platform and our customer base, and really focused on a couple things right now at the enterprise. Big strategic chunky deals. That's what we're working on, including acquisitions. We see companies that are doing this but can't do this nationally because they don't have the structure in place that we have, whether it's a banking relationship or the platform, the way our platform is designed. So there are small tuck-in opportunities that if we think they're accretive from an enterprise value perspective, we'll do those deals just to aggregate the demand. And what are you getting in a transaction? You're getting historical payment data. That's valuable to us because it just builds our data lake, but we're also getting revenue and income, right? If they're not generating positive income, we're not going to do it. It just doesn't make any sense for us. It has to be accretive. So strategic deals and acquisitions, over the next 6 months, new product launches, obviously, and more integration with some of the other industry-leading platforms that we see out there. And I don't want to get too specific on this, but we see, from conversations we're already having, opportunities to plug into essentially fintech partners that have customers, but they have a different kind of customer, and they think that we could provide a lot of value. And those are very large customer bases. So we have to be very surgical about how we do it. And all that's going to result in scale for us. So I would say I used to use the term crawl, walk, run here. We're starting to see more momentum happening this year. Some of the things we thought would be interesting and happening next year seem to be happening sooner. And I think that's good for us, obviously, and we're pretty excited about it, but we're really focused on getting some of these strategic opportunities done. So again, to highlight, we're looking at transactions, whether it's and we weigh this, really carefully. If we look at a transaction, and we're always looking at acquisitions, but if we don't like the equity issuance or the debt issuance or whatever the structure is relative to the earnings, we're just not going to do it. It makes no sense. We're all shareholders. So we have the ability to look at a number of transactions, and we have no problems about saying no to transactions if we just don't think it makes sense. And especially when you stand a transaction up against an organic deal that is basically the same size that you don't have to raise capital to do, you just launch it. The choice is usually pretty clear where you're going to put your resources, right? And we aren't Salesforce, so we don't have unlimited resources. So we literally have to have those conversations internally and say, where is our best use of resource time from an accretive perspective? And so it has to be a pretty special transaction for us to proceed with it when compared to organic growth, right? We've talked about, plugging with the banks and lenders and started making this available to them and launching new product. Cap structures in this deck's on our website. Cap structure is pretty clean, very simple, 70 million basic shares outstanding, fully diluted 86. Any options and warrants at this stage in the game are way out of the money, and that's okay. We think we're undervalued, but I want to get to the management side of this. So Jeff, really strong management team here, and this is what gives me a lot of confidence in kind of going after the elephants that we're pursuing. Jeff was a founding executive at Moneris. Moneris, obviously, a very well-known payment brand. Just forgotten more about payments than any of us know, and so very strong. Bill Holland, our chief technology officer, worked in the U.S. banking system and the Canadian banking system as a senior executive and leader in the IT space. Very, very strong, and he takes care of all of our tech execution. Ashish Kapoor actually was an ex-investment banker from Macquarie. So he has both the operational savvy as well as the structuring savvy within obviously his skill set and his team for transactions. Matt Mitchell, Chief Digital Marketing Officer. Megan Howell, many years in the automotive sector. So we have a very competent management team, and we try and keep our boards kind of small. There will be additions, strategic additions. A couple notables, Tamara, sits on the board of, and I sat on a previous board with Tamara. She's very strong, chair of our audit committee, and sits on the board of Meridian Credit, Credit Union Modus Bank, and Servo Annex. So, when we have sort of ideas that we think maybe are a little bit goofy, Tamara's kind of really good to run things by. Tim Farley out of the US, very connected within the institutional investment space, also an entrepreneur, but multiple successful exits. Jason Ewart, founding partner with me and others, also runs our capital markets. So, we will add to the board. I think we'll add sort of more US representation and more software representation as the opportunity arises. But a small board allows us to move pretty quickly.
Gotcha. And could you just give a quick high-level overview on the financials, like your run rate and burn rate and that sort of a thing, just on a high level?
Yeah. So I think run rate. Go back to the slide.
If you do, I think it was 1.38 you're doing now, so that was a little 4.5 million run rate. Oh, the annual run rate, yeah, but yeah. That's without transactions and growth. So that's just
sort of steady Eddie business.
Yeah.
And if we didn't grow, it would be, I think, around 150, 200 burn a month. But that's dropping fairly quickly because there's growth, you know. So I look at it this way. I mean, yeah, we have these massive models, but at the end of the day, every $50,000 in incremental sales a month is $40,000 in reduced burn, right? So it's we don't have to shoot the lights out to, and you know, and thank God, because the market's pretty sloppy this year. So you know, we never subscribe to building it out. And to be honest with you, if we weren't growing and if we weren't looking at transactions and some very, very large deals, we could be breaking even tomorrow. You know, we carry a certain amount of overhead to accommodate those future opportunities. If we felt that those future opportunities weren't going to happen, or we just wanted to start generating cash flow, within 90 days, we could be doing that.
All right. Well, we should be wrapping it up here. We've been going a while. I guess you sort of alluded to some of the things you're working on right now, but what kind of news flow should we be expecting, like through the end of the year? Like hopefully some big enterprise deals, maybe an acquisition.
Yeah, maybe an acquisition, and maybe two. We'll have to see how that shapes up, and it's all going to be back to the accretive nature of it. You know, if we're not going to do anything that issues too many shares down at these prices. But enterprise deals and really strategic partnerships, I think those are going to be very interesting. And I think they'll be game changing when they're announced.
Mike, I was about to call you Hank, but it's Mike.
That's my dad's name. It's okay.
Oh, that's where the name Hank came from?
Yeah. Yeah, he's pretty, you know, my parents didn't really have a lot of money, and they somehow managed to pay their mortgage off 10 years early, right? And so Hank was pretty good with the bank.
All right. Mike, thank you very much for taking the time to chat with us. Appreciate that. And love to have you back in a while and see how things are progressing. Have a great day and talk to you again soon.
Thanks so much.
Cheers.